Hey everyone, welcome back to the channel. Today, we're rediving into something that holds so many of us back from building real wealth, the fear of losing money. It's that little voice in your head that screams, what if it all goes wrong? Every time you think about investing or starting that side hustle, I get it. We're wired to avoid loss. Psychologists call this loss aversion, and studies show that the pain of losing $100 feels twice as bad as the joy of gaining $100. It's a powerful, primal instinct. But in today's world, that instinct can actually make you poorer. Let's talk about why, and more importantly, what you can do about it. So, why is playing it safe with your money actually the riskiest move of all? 2 words: inflation and opportunity cost. Let's start with inflation. Think of it as a silent financial termite, slowly eating away at the value of your cash. If your money is just sitting in a low-interest savings account, it's losing purchasing power every single day. That $100 in your account today might only buy you $95 worth of goods and services next year. Over a decade, the effect is massive. You're not just standing still. You're actively going backward financially. So, while you're afraid of losing money in the market, you're guaranteed to be losing it to inflation just by doing nothing. Then there's the even bigger, often invisible cost, opportunity cost. This is the potential gain you miss out on by choosing a safer, lower return option. Every dollar you keep in cash out of fear is a dollar that isn't working for you. It's not growing, it's not compounding, and it's not building your future. Imagine you had invested just a small amount in a simple S&P 500 index fund 10 years ago. The growth would have been substantial. By avoiding the short-term risk of the market going down, you would have missed out on a massive long-term gain. That's the real loss. We should be worried about the loss of what could have been. So, how do we start to reprogram our brains and shift our financial mindset from one of fear to one of smart, calculated growth? It starts with education. Fear thrives in the unknown. The less you know about investing, the scarier it seems. You imagine it's like a casino where you're just gambling your hard-earned money away. But that's not what smart investing is. So, start learning. Read books, listen to podcasts, watch reputable YouTube channels, and understand the basics of things like index funds, diversification, and compound interest. You don't need to become a Wall Street expert overnight. You just need to build a foundational knowledge that replaces fear with facts and confidence. The next step is to start small. You don't have to liquidate your savings and throw it all into the stock market tomorrow. That would be reckless. Instead, dip your toes in the water. Open a brokerage account and invest an amount you're genuinely comfortable with losing, say $100 or $200. Think of it as the price of your financial education. This small step does something incredible. It gives you skin in the game. You'll start paying attention to the market, you'll see how it moves up and down, and you'll realize that a down day isn't the end of the world. You'll experience a small dip and see your account recover. And this experience is what builds emotional resilience. It's like learning to ride a bike. You might wobble and even fall, but that's how you learn to balance and eventually ride confidently. Now, let's talk about a powerful strategy to combat fear: automating your investments. This is one of the single best things you can do for your financial future. It's called dollar cost averaging. Instead of trying to time the market, which is nearly impossible, you just invest a fixed amount of money at regular intervals, say $200 every month, no matter what the market is doing. When the market is high, your money buys fewer shares. When the market is low, your money buys more shares. Over time, this averages out your purchase price and smooths out the bumps. The best part? It takes emotion completely out of the equation. You set it, forget it, and let the system work for you, removing that moment of hesitation and fear that comes with manually clicking the buy button. Another crucial mindset shift is to change your time horizon. The fear of losing money is often a short-term fear. We check our portfolios daily and panic when we see red. But wealth isn't built in a day or a month. It's built over years and decades. Need to think like a farmer, not a day trader. A farmer plants a seed and does untig it up every day to see if it's growing. They trust the process. They water it, they give it time, and they know the harvest will come later. Your investments are your seeds. Plant them in good soil, like a diversified portfolio of quality assets, Sand, give them time to grow. When you zoom out and look at a chart of the stock market over the last 50 years, the short-term dips look like tiny blips on a massive upward trend. Focus on the long-term trend, not the short-term noise. Let's also address diversification. The old saying, do you put all your eggs in one basket, is the golden rule of managing investment risk. If your entire net worth is tied up in one single stock, then yes, you should be scared. That is extremely risky. But that's not how smart investors operate. Diversification means spreading your money across different types of assets, like stocks, bonds, and real estate, and also across different industries and geographic locations. So, if one sector is having a bad year, another might be doing well, balancing out your overall portfolio. A well-diversified portfolio is your financial shock absorber. It won't eliminate risk entirely, nothing can, but it reduces it dramatically and helps you sleep better at night. It's also important to have a clear plan and know your why. Why are you investing in the first place? Is it for retirement? A down payment on a house? Financial independence? Write it down. Get specific. Of course, when you have a powerful, emotionally charged reason for investing, it becomes much easier to stay the course during tough times. When the market drops and fear starts to creep in, you can remind yourself of that long-term goal. You're not just chasing numbers on a screen. You're building a better life for yourself and your family. Your why is the anchor that will hold you steady in a stormy sea. Finally, one of the most practical things you can do is to build a solid financial foundation before you take on significant investment risk. This means having an emergency fund. This is 3 to 6 months worth of living expenses sitting in a high-yield savings account. This isn't your investment money. This is your life happens money. Car breaks down. Lose your job. Unexpected medical bill. Your emergency fund is there to cover it, so you never have to sell your investments at the wrong time out of desperation. Knowing you have that safety net gives you the psychological freedom and confidence to invest for the long term, because you know your immediate needs are taken care of. Overcoming the fear of losing money is a journey, not a destination. It's about slowly and deliberately shifting your mindset from one of scarcity and fear to one of abundance and educated optimism. It's about understanding that the biggest risk isn't volatility, but stagnation. By educating yourself, starting small, automating your process, thinking long-term, diversifying your assets, and building a safety net, you can transform fear into your financial superpower. You can turn market dips from a source of panic into an opportunity to buy. Remember, every wealthy person you know has learned to manage this fear. You can too. Thank you so much for watching today. I hope this gave you a new perspective on fear and finance. If you found this helpful, please hit that like button and consider subscribing for more content to help you build your wealth and live a richer life. Let me know in the comments what your biggest financial fear is. Let's talk about it. Until next time, take care.